Hello students and welcome to the lecture. So students, as you can see here that basically in this lecture we are going to start the discussion over the non-performing asset, okay, their categorization and their resolution, okay. This is going to be our point of discussion, or we could say the topic of discussion for this particular lecture, okay. Like in this lecture we are going to cover these aspects: the DICGC, the key points of it, the insurance coverage under the DIGC, types of deposit cover under the DICGC, DICGC liable to pay, NPAs and SARFAESI, the bank become an NPA, out of order status, asset classification and the categories of NPAs, substandard assets, doubtful assets, loss assets. Okay. Then we will cover the important key concepts: the SARFAESI Act 2002, formation of SARFAESI Act 2002, role of SARFAESI Act 2002, objectives of SARFAESI Act 2002, applicability of SARFAESI Act 2002, and at last we will discuss the summary of all the things. Okay, so that is going to be our point of discussion in this particular lecture. But before starting this, as usual, we have our small disclaimer over here. That is what we require to understand before proceed with the lecture. So talking about the disclaimer is like, the images used in a slide deck are for educational purposes only. We respect the intellectual property rights of the original creators and owners of these images. If you are the owner of any of the images used in this deck and have any concerns or issues, please contact us at sathee@iitk.ac.in and we shall remove the images. Okay. Now, let's begin with the DICGC. So the DICGC, actually, if you look at this picture, you will find out that it stands out for the Deposit Insurance and Credit Guarantee Corporation. That is the full form of DICGC, and this is important from the examination point of view. We all must be aware about this: Deposit Insurance and Credit Guarantee Corporation. Okay, but before starting this, we must understand like how does the DICGC begins. Okay, a brief history of this. So basically, the Deposit Insurance Corporation Bill, DIC bill, that bill was introduced in the Parliament of India on 21 August 1961. Okay, and it got the assent of the President on December 7, 1961. And as the result of this, the Deposit Insurance Act 1961 came into force on January 1st, 1962. Okay. But before this, or before learn about this, we must understand that why did we need it? What was the need of this, that we established this kind of organization in our country? And that is to be understood by us first before proceeding further. Got it? Talking about this, so basically, suppose if we talk about from the banking point of view, bank having two primary functions. First, they accept the deposit from the people. Okay, on deposit they entitled to give some interest to the person who has deposited his money with the bank. Second, the person lend out the loans to the people. Okay, and the bank charge some interest from the people, and this is the income of the bank also. Like you can say, if someone is receiving a deposit from, is receiving an interest on his deposit from the bank, which is at 4%. The bank lended out loan to someone and now bank is charging 7%. So 7 minus 4, 3% is an excess amount, and that is the income of the bank, right? But remember, the bank is a greedy organization. That is a thing that I'm repeating again and again, because bank is always works for its profit. Got it? So that's why because the bank is earning the income by lending out the loans and making the investments. So what will be the bank do? The bank will try to lend out more and more loans to the people, so that the bank will receive more and more interest from the people and more income also. That is what bank really want, right? But what money is actually the bank holding? It is a depositor's money, right? So suppose if the bank has 100 crores with it, out of these 100 crores, some amount the bank has deposited as a reserves like CRR, cash reserve ratio, SLR, statutory liquidity ratio. Remaining 60 crores the bank had lended out, and this 60 crore is actually got slit, or we could say that the bank is not getting return amount of this 60 crores, which means the 60 crores have been waived out from the bank's account. Now the people who had deposited their money with the bank, where they will go? Because the bank has lent out their funds, right? So to cover up this, basically the institution like Deposit Insurance and Credit Guarantee Corporation came into the picture. This give you assurance, like if you deposited your money with the bank and even if the bank falls down in the future, you will receive up to 5 lakh as your deposit. Okay, like if you deposit rupees 10 lakh, then up to 5 lakhs you will receive from it. Okay, and if your amount was below 5 lakh, then you will receive it definitely. All right, that was a thing. So that's how the thing began in actually on August 21, 1961, when the bill was introduced in the parliament. President provided his assent on December 7, 1961, and as the result of this, the Deposit Insurance Act 1961 came into the picture on January 1, 1962. Initially, the deposit insurance scheme extended to function commercial banks only. Like you can say, when it was introduced in the 1961, it was only covering the commercial banks. This including the State Bank of India and its subsidiaries, and other commercial banks, and also the branches of the foreign banks that were operating in India. Okay, like we could say mainly the commercial banks were in the purview with the DICGC. Then, since 1968, with the enactment of Deposit Insurance Corporation Amendment Act 1968, when this came into the picture, the corporation was required to register the eligible cooperative banks as insured banks under the provisions of Section 13A of the Act. Okay, like those are non-commercial banks but the cooperative banks. Those banks, because also entitled to receive the deposit from the people, these banks also got registered with the DICGC through the Deposit Insurance Corporation Amendment Act 1968, so that they could be entitled as an insured bank. The Government of India, in consultation with the Reserve Bank of India, introduced the Credit Guarantee Scheme in July 1960. Like we could say, for the economy well-being, the banking function is necessary, and bank will only function when they have a sufficient deposit, and people will only deposit their money to the bank if they feels the money with the bank is safe. And for this, basically we have Credit Guarantee Scheme. Okay, thereafter the Reserve Bank of India promoted a public limited company on 14 January 1971, named the Credit Guarantee Corporation of India Limited, CGCI. That was actually aimed to encourage the commercial banks to cater to the credit needs of the hitherto neglected sectors. Okay, like providing the credit to them, the neglected sectors which are generally not entertained by the banks because they are not so profitable to the bank as the others. Okay, with a view to integrating the functions of deposit insurance and credit guarantee. Like you can say, deposit insurance means those who had deposited their money with the bank, their money is safe. Credit guarantee, those who neglected by the normal banks and wanted a credit, they will get a credit facility. So all these two things were to be integrated together. The above two organizations, the first is DIC, Deposit Insurance Corporation. Second one was Credit Guarantee Corporation India. They got merged, and then the new organization formed known as the Deposit Insurance and Credit Guarantee Corporation, DICGC, that came into existence on July 15, 1978. Okay. Also, the title of Deposit Insurance Act 1961 that got changed to the Deposit Insurance and Credit Guarantee Corporation Act 1961. Got it? Thereafter, now we know that how does the DICGC you can say formed after merging the DIC and CGCI. Now, what is the mission of DICGC? Mission of DICGC. What was this? It is to contribute to the financial stability by securing the public confidence in the banking system through provision of deposit insurance, particularly for the benefit of the small depositors. Got it? Vision of DICGC: to be recognized as one of the most efficient and effective deposit insurance providers responsible to the needs of its stakeholders. Okay. Thereafter, some key points that we are required to be understand. First is functions of the DICGC governed by the provisions of the Deposit Insurance and Credit Guarantee Corporation Act 1961. So we can say this is actually a statutory body because it is having its own act, and all the functions and responsibility the DICGC holds for the stakeholders are deriving from this particular act. The authorized capital of the corporation is nearly about 50 crores, and it is fully issued and subscribed by the Reserve Bank of India. Okay, like when it was formed. Where is the head office? So the head office is at Mumbai. Okay, Maharashtra. The current chairman of DICGC is Shri BP Kanaku. Okay, and it is advisable to all of you, kindly check it because that could be changed over the period of time. All right, so this is not a static fact. This is you have to check by yourself. Okay, and then now let's move forward. So which banks are actually covered under the DICGC? Like we know that this was created for the banking coverage. So which banks are generally covered by it? All commercial banks, that including also the branches of foreign banks functioning in India. Like if the foreign bank gets functioning in India and it is a commercial bank, that will also got covered under the DICGC. Local area banks, the banks which are not so much widespread but having the local networks, these will also got covered under the DICGC. And all the regional rural banks, also known as the RRBs. Okay, these banks will be got covered under the DICGC. Cooperative banks, all eligible cooperative banks defined under Section 2 GG of the DICGC Act are covered by the Deposit Insurance Scheme DIS. At present, all cooperative banks covered by the scheme. Got it? Now, what insurance coverage under the DICGC? Under the provision of Section 16(1) of the DICGC Act, the insurance cover is given. Okay, like each depositor in a bank is insured up to the maximum of rupees 1 lakh. Okay, remember that is now updated and up to rupees 5 lakh is allowed. Okay, for both the principal and the interest amount held by him in the same right and same capacity as on the date of liquidation and the cancellation of bank's license, or the date on which the scheme of amalgamation, merger, reconstruction comes into the force. So whenever anything happens that could impact the deposit of the depositor, then up to rupees 5 lakh, previously it was rupees 1 lakh, okay, that could be saved by the bank, okay, or by the DICGC. That will include the principal amount and also the interest amount that will be calculated on this. Got it? Now the types of deposits that covered under the DICGC. What kind of deposit got covered here? So DICGC ensures all bank deposits like the saving deposit, fixed deposit, current deposit, recurring deposit, etc. Except the given following types of deposits. These deposits are not secure or covered by the DICGC. First, deposit of foreign governments will not cover. Deposit of central or state governments will not cover. Interbank deposits will not cover. Deposit of the state land development banks with the state cooperative banks will not cover. Any amount due on account of and deposit received outside India will not cover. Any amount which has been specifically exempted by the corporation with the previous approval of the RBI, that will be not covered. Okay. Now let's move forward. Now here are some important notes that we are required to understand. First, if you have deposit with more than one bank, the deposit insurance coverage limit is applied separately to the deposits in each bank. Like suppose if you are having a deposit in 4 banks, okay, then it means the DICGC will give you coverage up to all the banks, okay, where you have deposited your money. Okay, it doesn't mean that you have to only go by the one bank. You could have access to the other banks also. Second, deposit insurance premium is borne entirely by the insured bank. Okay. Third, the deposit insurance scheme is compulsory and no bank having a right to withdraw from it. Like no bank could say that we will not go by this and that. No, this option is not available for any bank. Fourth, premium charge is rupees 10 paise per 100 accessible deposit. The formula to calculate this is premium equal to deposit in rupees rounded to 1000 into 0.10 divided by 100. On this particular formula, we calculate the premium charge on the deposits. Now, what is the DICGC liability? If a bank goes into the liquidation, means the bank is now not so much healthy to work and the bank is closing its business. Amount of its deposit up to rupees 1 lakh within 2 months from the date of receipt of claim list from the liquidator, or corrected rupees 5 lakh is now there. If a bank is reconstructed or amalgamated, merged with the another bank, then Deposit Insurance and Credit Guarantee Corporation, wholly owned subsidiary of the Reserve Bank of India, will give the money to the depositor under the insured scheme. Now, what are the NPAs and the SARFAESI? Now, this is actually a very, very important topic to be discussed. The NPA stands out for the non-performing assets. Like talking about from the bank's point of view again, the amount which we deposit with the bank, it is actually the liability of the bank. That money does not belong to the bank. The bank has to return us to us whenever we requires. Okay. The loan the bank lend out to the people, that is actually the asset of the bank. How? Because the bank is lending out this and the person who had taken a loan from the bank required to repay it. Got it? That's how the system works. Alright. But non-performing assets, like that particular loan or asset or investment that the bank has made, which is not generating any income to the bank, that is actually regarded as the NPA or non-performing assets. What is non-performing asset? Let's have a look on this. An asset, including a leased asset, becomes non-performing when it ceases to generate income for the bank. Like what I told you. NPA was defined as a credit facility in respect of which the interest and or installment of principal has remained past due for a specific period of time. It means no interest has been given by the person who had taken the loan. Even the installment of principal amount has not been paid by the person to the bank in some specified period of time. Then it is actually considered as a non-performing asset, which means the asset the bank had created which is not generating the income for the bank. The bank becomes an NPA. With effect from March 31, 2004, the non-performing asset got a definition, and it will be a loan or an advance where first, interest or installment of principal remains overdue for the period of more than 90 days in respect of a term loan. Not talking about the personal or the short-term loan, term loan. Okay, that is actually given for the long duration and with some purpose. The account remains out of order for the period of more than 90 months in respect of an overdraft or cash credit, which means no transaction has been held in that particular account. Then it will be known as the out of order. Third, the bill remains overdue for the period of more than 90 days in the case of bills purchased and discounted. Okay, which means the money has not been paid. The interest or installment of principal remains overdue for 2 harvest season, but for a period not exceeding 2 half years in the case of an advance granted for the agriculture purposes. Then, any amount to be received remains overdue for a period of more than 90 days in respect of the other accounts. The installment of principal or interest thereon remains overdue for 2 crop seasons for short duration crops. The installment of principal or interest thereon remains overdue for 1 crop season for long duration crops. Now, what is the out of order status? An account should be treated as an out of order if the outstanding balance remain continuously in excess of the sanction limit drawing power. In cases where the outstanding balance in the principal operating account is less than the sanction limit drawing power, but there are no credits continuously for 6 months as on the date of balance sheet or credits, these are not enough to cover the interest debited during the same period. These accounts should be treated as the out of order. Thereafter, what is the asset classification or categories of NPA? Banks are required to classify the non-performing asset further into the following 3 categories based on the period for which the asset has remained non-performing: substandard assets, doubtful assets, or loss assets. Like first is the substandard assets. With effect from March 31st, 2005, a substandard asset would be one which has remained NPA for less than or equal to the 12 months. It means it is NPA for 1 year. Doubtful assets. With effect from March 31, 2005, an asset would be classified as doubtful if it has remained in the substandard category for a period of 12 months. Loan classified as doubtful has all the weaknesses inherent in excess that were classified as substandard, with the added characteristic that the weakness make collection or liquidation full on the basis of currently known facts, condition, and values highly questionable and improbable. Loss assets. A loss asset is one where loss has been identified by the bank or internal or external auditors or the Reserve Bank of India expansion, but the amount has not been written off wholly, which means such an asset is uncollectible and of such little value that is continuous as a bankable asset, not warranted, although there may be some salvage or recovery value. Now the important key and concepts we talk about. Fully secured. When the amounts due to a bank present value of principal interest receivable as per restricted loan terms, these are fully covered by the value of security duly charged in its favor in respect of those dues. The bank dues are considered to be fully secured. It means the bank will recover it. Restructured accounts. Restructured account is one where the bank, for economic or legal reasons leading to the borrower's financial difficulty, grants to the borrower the concessions that the bank would not otherwise consider. Restructuring would normally involve modification of terms of the advances securities, which would generally include, among others, alteration of repayment period, repayable account, the amount of installment, rate of interest, due to the reason other than the competitive reasons. Then, SARFAESI Act we have 2002, related with the same thing. Narasimhan Committee 1 and 2nd and Ardujunia Committee, considered by the central government for the purpose of examining the banking sector reforms, considered the need for changes in the legal system in respect of these areas. These committees made suggestions in form a new legislation for securitization and empowering banks and financial institutions to gain possession of these securities and to sell them without any intervention of the court. Formation of SARFAESI Act 2002. That act stands out for Securitization and Reconstruction of Financial Asset, Enforcement of Security Interest Act 2002. circulated to regulate the securitization and reconstruction of financial assets, enforcement of the security asset, and for matters connected therewith or incidental thereto. Now, the role of SARFAESI Act. First, acquire the financial assets by issuing debenture or bonds or by agreement, realize the same and redeem the security receipts issued to the QBs. Second, reconstruction of financial assets. Take measures for proper management, sale, debt reconstruction, settlement, or take possession subject to the RBI guidelines from time to time. Enforcement of security asset. Enforce security interest by the security creditors without the intervention of the court. Other function, act as an agent of banks, FIs for recovery, act as manager of the secured asset appointed by the lender, or act as a receiver appointed by the court. Objectives of the SARFAESI Act. Efficient or rapid recovery of NPAs of the banks and FI, allow banks and financial institutions to auction properties like commercial residential when borrower pay to fail the loans. This process to be followed. Applicability of SARFAESI Act 2002. Registration and regulation of asset companies by the RBI of India, facilitating the securitization of financial assets of banks and financial institutions with or without the benefit of underlying securities. Promotion of seamless transferability of financial assets by the ARC to acquire the financial assets of bank and financial institution through the issuance of debentures or bonds or any other security as a debenture. And trusting the asset reconstruction companies to raise fund by the issue of security receipt to qualified buyers. Facilitating the reconstruction of financial assets which are acquired while exercising powers enforcement of securities or change of management or other powers which propose to be conferred on the banks and financial institutions. Then, presentation of any securitization company or asset reconstruction company registered with the Reserve Bank of India as a public financial institution, defining security interest to be any type of security including mortgage and change on removable properties given for due payment of any financial assistance given by any bank or financial institution. Classification of the borrower's account as an NPA in accordance with the directions given or under guidelines issued by the Reserve Bank of India time to time. Officer authorized will exercise the right of secured creditor in the behalf of the accordance with the rules made by the central government. Appeal against the action of the bank or financial institution to the concerned debts recovery tribunal, and second appeal to the appellate tribunal will be there. Central government may set up or cause to be set up the central registry for the purpose of restriction of transaction relating to securitization, asset reconstruction, and creation of the security interest. Application of the purpose legislation initially to banks and financial institutions empowered of the central government. Extend the application of the purpose legislation to non-banking financial companies and other entities. Non-application of the purpose legislation is to security interest in agricultural lands, loans less than rupees 1 lakh in cases where 80% of the loans is repaid by the borrower. Now here we have finished the topic. Now it's part of summary. History of DICGC we have seen, like the timelines we have seen. Okay. Mission and vision of DICGC we have seen. Functions and structure of DICGC we have seen. Coverage and exclusions we have seen. Then the deposit insurance premium we have seen. Claim process we have seen. Okay. Then NPA we have seen. The definition, classification and categories we have seen. Special terms related to the NPAs we have seen. Legal framework for recovery of NPAs we have seen. Key process under SARFAESI we have seen. Conclusion of the DICGC we have seen. And with this we have finished this topic. So it is requested to all of you, kindly revise the facts and figures that all we have discussed in this lecture and keep yourself ready for the next lecture. With this note, let's end this lecture and thank you.